Every single day, over 40 million options contracts are traded in the US stock market. That's billions of dollars moving quietly behind every major stock and ETF you see, including SPY, QQQ, Apple, Amazon, Meta, Tesla, and the list goes on. And yet, most beginners still think that options is this overly complex, high-risk game that only professionals can play. The truth is, once you understand how options really work, you'll realize that they are simply tools. Tools that can help you grow your account faster, protect your investments, and trade with more flexibility than stocks allow. In this video, I'll walk you through the foundations step by step. What options actually are, how traders make money with them, what influences their price fluctuations, and how to trade them responsibly. This is the same foundation I teach each of my students before they even risk $1 with options trading. What are options? Options trading sounds complicated until you realize it's just a contract that gives you choices. If you understand this one rule, you'll finally understand what options trading actually means. An option is a contract that gives you the right, but not the obligation, to buy or sell a stock at a specific price within a specific period of time. Think of it as reserving something at today's price, even if that price changes tomorrow. You're not required to go through with the purchase, but you have the right to at that specific price. There are two types of option contracts: call options, which give you the right to buy, and put options, which give you the right to sell. When you buy a call, you're betting that the stock price will go up. When you buy a put, you're betting that the stock price will go down. Instead of investing thousands buying stock shares outright, one option contract lets you control 100 shares of that stock, typically at a fraction of the cost. That's the leverage that makes options trading so appealing. This leverage in options is extremely powerful. How a call option works. This is how traders use options to multiply profits without owning a single share of stock. Let's say Nvidia is trading at $150 per share, and you believe that stock price is gonna rise within the next month. You could buy a $150 call option that expires in 30 days. That contract gives you the right to buy 100 shares of Nvidia at $150, no matter how high the stock goes. Now imagine Nvidia's stock price climbs to $190. That means your option contract gives you the right to buy 100 shares of Nvidia at $150, even though the current market price is $190. That's a $40 profit per share, or $4,000 of potential gains, since one option contract gives you the right to control 100 shares of the stock. You don't need to actually buy the shares though. Most traders simply sell the option contract itself for the profit as the value of the stock increases. Maybe you paid $1,000 for the option contract when Nvidia's stock price was at $150. A few weeks later, that could be worth $4,000, the option contract itself. That's a 300% gain without owning a single share of stock. But that leverage works both ways. In 30 days, if Nvidia's stock price had dropped below $150, that same contract could have expired worthless. That's why options require clarity, not emotions. An important detail of options trading is the multiplier. Every standard stock option controls 100 shares. So when you see an option premium priced at $5, that doesn't mean that it costs $5 to enter the trade. That means that it cost $500 to enter the trade, because that's the $5 premium times 100, the 100 shares that you will control with your one option contract. That's why small price changes in the option contract can lead to large percentage gains or losses. If a contract premium moves from $5 to $8 and you have one contract, that's $300 of profit. If the option premium drops from $5 to $2, that's a $300 loss. It's the same move, just in the opposite direction. That's why the best traders think in terms of risk-reward ratios, not just direction. How a put option works. Options trading isn't just for uptrending markets. Traders can also make money when stock prices fall too. So let's flip it. A put option gives you the right to sell a stock at a fixed price. That's how traders profit when the stock price moves down. Let's take Tesla as an example. Say Tesla is trading around $450, and you believe that Tesla's stock price is going to drop to $400 within the next week or two. You could buy a $450 strike price put option. That contract gives you the right to sell Tesla at $450, even if in 2 weeks the market price is lower than that. Now, most Tesla options cost around $1,000, and that controls 100 shares of the Tesla stock. So instead of shorting Tesla directly, which has margin risk, or buying those expensive shares, you're able to control 100 shares at a fraction of the price. Here's where it gets interesting. Let's say Tesla does drop from $450 to $400. That would be a $50 move in your favor. If your options contract has a delta 40 cents, that means for every $1 that the stock moves in your favor, your option contract will gain 40 cents of value. Therefore, a $50 move in the stock price in your favor times your 40-cent delta equals $20 of movement in your options price. Since one option controls 100 shares, that's a $2,000 gain. If you bought the option contract for $1,000 and you saw a $2,000 gain on your option contract, that's a 200% return on your investment, all from a $50 drop in Tesla's stock price. Now that's a simplified example. In reality, the price of your option changes dynamically as delta, theta, and vega all shift with volatility and time. For instance, if the move happens faster than expected, your volatility will spike, and that can increase your profits even more. That sensitivity to volatility is measured by another options Greek called vega. On the other hand, if the move happens slowly or time starts running out on your option contract and it hasn't hit your target yet, theta, or time decay, starts eating at the value of your option contract. That's why I never hold my option contracts until that expiration date. I always exit before expiration. I always decide my exit price before I enter in the trade. I determine my exit price both if I'm right and if I'm wrong. Because if the stock doesn't move in your direction fast enough, the options value can shrink even if you were technically correct about the direction that the stock went. That's the trade-off for leverage. And that's why options traders use structure and timing, not emotion, to win consistently. Now, if you want to see a step-by-step guide on how to become a day trader, the next video I recommend is this one right here. I'll see you in the next one.